You have a bullish call on Chinese stocks. You think CSI 300 could test 5,000. You're currently looking at 4,590 on the CSI 300. What gives the index that leg up? What gives Chinese stocks that momentum? And what is the time frame that you're looking at?
Okay, thank you, Thomas, for having me here. Yes, we have been previously sticking to our view that CSI 300 will range about 4,005 to 5, but based on where we are, given this recent correction, we think it's a good opportunity. Recent results from the first half has really indicated that China is undergoing a cyclical recovery, given that the broader Asia, which represents about 50% of the Chinese economy, is now facing inventory shortages. Now, this is driven definitely by the fact that we have a very strong pickup in the second quarter revenue, top-line growth. At the same time, we have this concerted effort to destock the channel to protect cash and also capital. Now, with that, looking forward and also looking at what the consensus is looking for in terms of the growth outlook, that we see a restocking cycle definitely kicking in. But what is most interesting here is that the entire capex in the second quarter and the first half of this year is actually down. And that means that operating utilization and positive leverage will start to boost profitability in times of an expansionary production volume. So that's why we think the market that is previously pricing in all this negativity needs to start looking at how to measure the gain in terms of positive operating leverage to the entire growth structure.
Okay, that makes sense, Alexious. But, you know, we're looking at the economic data, and we've been discussing it this morning. It is a divergent picture. You just need to look at the consumer. At the top end, they're doing fairly well. Out in rural parts of China, there's a lot more pressure. How do you break down, then, as an investor, what is looking like a divergent and less than fully healthy recovery here in China? How do you position for that?
Well, I think the better way to look at things is that China as an entire economic health is definitely recovering. And at the same time, investors should be looking at the broader implication of the rural areas or the lower tier cities that is actually still behind in terms of economic growth will definitely get more stimulus and at the same time more support measures. And while the tier 1, tier 2 cities that have already recovered due to all these economic stimulus and monetary easing measures will start to see some normalization. And you will start to see things moving in a broader basis. That's why if you look at where we are, we have been overweight on like the construction that is for job creation, for self-employment, the capital goods. Also, we are also excited about the effects of autos because these are some of those sectors that will probably benefit from more what they call funding mechanism and more easing of monetary measures in the lower tiers in order to comply with Chinese anti-poverty measures.
And Alexious, you mentioned that trend that perhaps the market is overlooking right now, which is capex is down and which could potentially boost the profitability of some of these companies. Where are you seeing that sort of activity happening across sector to sector, and does it warrant some type of repricing now?
Well, this is a very good question because if you break down the entire Asian market data and look at the whole Chinese macro data, you will see that capex reduction is actually broad-based, except for the fact in healthcare because of those newly rolled out capacities in the PPE segment. Across the board, we see an average of decline of about 8 to 10%. So this means that companies that used to be operating at 80% utilization could see 90% utilization. That means more GPM and OPM production. So we think that the most obvious decline or reduction in new capacity is the likes of capital goods and autos. Now, mainly because you also see a big jump in their volumes. So that's why we have flagged numerously that based on the second half outlook, we must stick to the sectors that see a big jump in the second quarter revenue and gross profit margin per product, especially given the right reach through to operating utilization.